All right, let's talk DocuSign. For a while there, they were kind of in the penalty box with investors, but they just dropped a blockbuster quarter and the stock took off. So today we're going to dig into the numbers and the massive AI bet that seems to be fueling a major comeback.
After a pretty shaky first quarter, all eyes were on DocuSign. The big question on everyone's mind was, is this new strategy actually working? The pivot to an AI-powered platform. Well, the market was waiting for a verdict, and boy, did it get one. And that verdict was, without a doubt, positive. I mean, it came straight from the top. The CEO, Allan Thygesen, didn't mince words at all, calling the quarter outstanding. He pointed directly at the company's AI launches and sales strategy changes as the real engines behind the strength they saw across the whole business.
And Wall Street's reaction? It was immediate. The stock jumped about 7% in after-hours trading. Now, that's not just a sigh of relief. That is a loud and clear vote of confidence in the company's new AI-driven direction.
Okay, so what exactly did Wall Street see that got them so excited? Look, this wasn't just a narrow win. DocuSign didn't just squeak by expectations. They delivered a real statement quarter that absolutely crushed them on every important metric.
The number that really, and I mean really turned heads was billings. Now, this is a super important indicator of future revenue. It grew a massive 13%. Just to put that in perspective, this is one of DocuSign's strongest growth numbers in 2 years. It's a huge signal that customer demand is heating up again. And that demand, it flowed right into revenue, which came in at over $800 million for the quarter. That's a really solid 9% increase year over year, which just goes to show you the core business is still incredibly healthy. And here's the kicker. This growth was profitable. Their adjusted earnings per share, which is how we look at profitability, hit 92 cents. That sailed past analyst estimates, proving this wasn't just growth for the sake of growth. Nope, this was smart, efficient growth that went straight to the bottom line. So when you put it all together, the picture is just undeniable. I mean, whether you're looking at future demand with billings, current sales with revenue, or profitability with EPS, DocuSign cleared every single bar the analysts set, and they did it with room to spare. This is what a clean sweep looks like, and it's exactly why that stock popped. So the big question is, how they pull it off? An impressive quarter like this doesn't just happen by accident. It was actually the direct result of a really deliberate, two-pronged strategy that is clearly starting to pay off in a big way. The whole strategy really boils down to these two pillars. First, they got super aggressive with innovation in their AI-powered Intelligent Agreement Management platform. They call it IAM. And second, they did a major overhaul of how they sell and get their product to market. Let's break each of those down. On the product front, you have to understand DocuSign is moving way beyond just e-signatures now. They're rolling out some seriously powerful new AI features for that IAM platform. Think about things like custom extractions, which lets AI pull key data from thousands of contracts almost instantly, or agreement preparation, where AI actually helps build the document for you. They're basically turning boring static agreements into smart, searchable assets. Now, you can have the best product in the world, but it's useless if you can't sell it, right? And this is where their sales overhaul is really shining. It's leading to stronger direct sales for sure, but they also expanded their reach in a big way, landing their largest deal of the whole quarter through the Microsoft Azure Marketplace and signing a new partnership with the U.S. General Services Administration, the GSA, which basically opens the door to the massive federal government market. A great quarter is, well, it's great, but investors always want to know what's next. And on this front, DocuSign's management showed a ton of confidence by raising its full-year guidance. When a company does that, it's a powerful signal that they believe this momentum isn't just a fluke, it's sustainable. And we're not talking about a tiny little nudge up either. They made some pretty significant increases. The company raised its full-year revenue guidance by $38 million and its billings guidance by $28 million. When a management team raises its forecast by that much, they're basically telling Wall Street, hey, the trends we're seeing aren't just strong, they're getting stronger. Of course, it's not all sunshine and rainbows. Management was pretty open about a couple of headwinds they're dealing with. For one, this is the peak year for costs tied to their big cloud migration, and they're also managing some shifts in how they compensate employees. But, the fact that they could raise their guidance despite these pressures, that just adds even more credibility to how strong this quarter really was. Okay, so we've got an impressive beat and raise quarter, all driven by slick AI innovation and even sharper execution. The question now is, what does this all mean for the next quarter? It's time to put on our analyst hats. What should investors be watching for, and how could the stock react as this whole story keeps playing out? Let's try to frame a thesis here. Based on this accelerating momentum and this really crisp execution we're seeing, the call here is outperform. All the evidence suggests that DocuSign is just in the early innings of a really successful pivot, and the market is only just now starting to recognize and reward it. So here's the thinking. We're predicting that Billings number will stay strong as more and more big companies start adopting the new IAM platform. And as DocuSign keeps proving it can execute quarter after quarter, we expect the stock to build on these recent gains. Now, the key catalyst, the thing you really want to watch for, is any commentary about IAM hitting a low double-digit percentage of their business by the end of the year. If they hit that target, it would be a massive proof point that this transformation is the real deal. Of course, this is not financial advice.